Welcome to the Furlough Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people to invest wisely in both properties and residents so that together we can build wealth while improving housing. I'm James, and this is my wife, Jessie.
I'm here, and we ate hamburgers for dinner. It was
nice.
I was saved because I forgot that we had buns in the fridge.
Okay.
And our son apparently will not eat hamburgers without a bun. I was like, whatever, just eat the patty. Like,
okay.
I don't know, chop it up. And he was like, that's not a hamburger. I was like, okay.
Oh,
well,
man.
Hopefully we have buns. And he found some, so.
Cool. It worked out.
Yeah.
Yeah, and when we tend to make burgers, we don't do them on a grill, typically.
Yeah,
we just do them on a little pan
cook
and
'em.
pan-fried. Is that what that's?
Fine. Yeah,
Sure.
fried burgers.
Technically, right? Pan-grilled burgers?
I don't know. It's a burger either way.
It's fine. Works for me.
Winter burgers.
Winter burgers. Yeah, I like burgers. I could eat a lot of burgers. All right, question. If you were stuck with having to eat hamburgers all the time, or I guess let me rephrase this. If there was one food that like this is what you're stuck eating the rest of your life, this one thing, what would it be?
Pumpkin pie.
Pumpkin pie, huh?
Done.
Just all three meals, everything?
Oh, yeah.
Wow, I feel like
I love pumpkin
that would
pie.
cause a problem after a while. My answer is pizza, because I feel like you can also get a lot of variety in there, and it's just like even if it's the same topping every time, it's a good mix of all the different types of
even with
food
like
groups.
Within the slice, there's variety.
Correct. Yeah.
I don't know that
cheese pizza.
I
don't know
would
so
care.
much.
I mean, there's had to be some pretty extreme circumstances for me to be eting one thing the rest of my life.
Well,
so.
I'm glad you bring that up because today we are going to be talking about exploring extreme circumstances, specifically talking about stress testing deals. And part of doing that is going to the extreme of a thought process, right? Of saying, hey, maybe you like this food. Awesome. Yeah. How much do you like this food? How far
if it could
are you
only
willing
be
to
one
go?
way.
At what point in time does this mental model of yours break?
Yeah.
Yeah, so that's what I'm talking about. And it's all important for all sorts of issues, right? It's good for identifying risks, to keep with this food metaphor we got going on, right? What's the downside of you just eating pumpkin pie for the rest of your life, right?
Eventually.
Yeah, there's probably some obesity in there. Who knows?
I don't know. I mean, 3 slices a day, that's reasonable.
I think the other thing, too, is it helps you overcome overconfidence. Right? If you're like, is like, you make that initial, I could eat this all the time,
yeah, it's
right?
So good.
The value of stress testing something is like, all right, well, like, let's actually play that out. What does it look like, right? And you were already starting to hedge in your comments there, right? Like, your initial reaction was like, pumpkin pie, easy, and you're already in like, okay, let me think about it. And that's the point of the stress testing, not just to make these overconfident, off the cuff assumptions, but to just like to spend a little bit more time,
prove things out
through. Yeah, and I think it's also just important to smart investors just don't. They're not afraid of uncertainty. Instead, they plan for it. They plan for the unknown, and they're not afraid to ask like, what could go wrong, and how do we ensure that whatever this thing is doesn't sink us.
Okay.
Yeah, so
you don't necessarily know.
Maybe you could do pumpkin pie the rest of your life.
Yeah.
Maybe not
I don't
that
know.
one,
You don't necessarily know, but you're like poking holes, or at least taking things to their logical conclusion to try to.
Well, I think it's
estimate what would happen.
It's a fundamental mindset of saying I don't actually know what the outcome is. And I'm okay with that.
But you're considering all the possibilities.
I'm going to explore different tendrils of options.
Yeah, that makes sense.
Yeah, and there's a couple different sources that I use. One of them, I don't even think I wrote it down. It's the art of, what is it called? It's the art of scenarios, the art of the long term. That's it. The art of the long term, which is this whole idea of long term. But we're gonna get to that in a little bit. It's a really good book. It's an okay book. But there's 2 ways that you can think about scenario planning. There's your short term, like your micro, thinking about some key variables. And then you have your long term, which is more macro, and that's more like what are those bigger driving forces going on. And depending on when you're looking at a deal, and you kind of want to pay attention to both, but like you want to either zoom in, weigh in on like, okay, what's happening right here, right now, or zooming out. So on the zooming in, I bet you could guess what some of those like key metrics are that you want to take a look at.
Like is the property in good condition?
Yeah,
Is that
well,
macro or micro?
well, that's a known thing, right? Where this is more like,
Oh.
okay, yeah. Okay, great. So it's less of like looking at it today. It's more of like saying, this is what I think it'll be tomorrow, 6 months from now, a year from now. So like, what's a very key metric that's really important that you don't technically know 6 months to a year from now?
How much it will rent for?
Yeah, that's a huge one. Yeah, what are the market rents going to be?
I mean, you kind of could make some assumptions, I guess.
Right. Well, that's the point. It's recognizing that it's an assumption that you don't actually know. And obviously, the nice part about having, like, say, a multifamily is you have a lot of other data to go with. If it's a single family home, you obviously have a lot less.
Interesting.
If you are fixing up the units, you have a lot less.
Yeah.
And there's those kind other ones would be occupancy rates. And even on the
does that change?
Oh yeah, totally.
Oh.
It does. It's very low in this area right now, but yeah, generally, like for example, think about we're near OSU campus. The occupancy, like the rent rates, are very different springtime versus.
You mean like vacancy?
Yeah.
I was thinking like how many people could stay in a unit or not.
No,
like
that's pretty stable.
What's the occupancy?
There are discrimination
There's rules
laws for that
about
one.
how many
It's
people, but
two per bedroom
it's
plus
like
one, by the way.
vacancy. That changes over different seasons.
Correct.
Okay.
Yeah. That's fair. And I would also say in terms of like for the rent piece of it too, it's not just what do you think it is in 6 months from now, but like what's your annual growth rate that you give to it? That's a huge assumption.
Yeah.
That you just don't know. So that's on the revenue side.
Okay.
And then you have the expense side of
Maintenance
things.
costs?
Yeah.
Or like you don't know if something's going to break or not.
Yeah. Repair and maintenance costs are definitely one of them. And so that's an area where you can tweak those assumptions up and down.
Yeah, you'd be a lot more conservative or not.
Yeah. And that's a huge one for like when we're flipping a property. And we're going to be spending a significant amount of money on the rehab. Yeah. It's really important to scenario plan those out and say like, okay, what do we do if costs end up being not just 10% higher, but 30% higher? What does that look like? What's my break-even point where, man, if costs get out of control, like we're okay with it being this, but man, if it goes even higher, I'm in trouble. Those are
so
good things to
as
know.
you're stress testing this out and going through those scenarios, do you create like contingency plans for, if you, for example, like in the one that you just said, if costs end up being 30% more than you initially planned on or calculated, like what do you do? Do you raise more funds? Do you just punt? Do you walk away? Like what are, like, you know what I mean? Do you think through the answers as well?
Yeah, and usually at the time that you're doing the stress test is at the acquisition side. So it's before you bought it. And so you might be saying, you might say stuff like, usually it's a yes or no. Okay. Right? Yes, I can handle 30% overruns and at least break even or something like that. But if I think there's a high probability that it could go beyond that, like I just don't buy it.
Yeah.
And then I suppose you can have a situation where you say, if it gets above this, we're gonna like, because it all gets dynamic really quick, right? If you're like, well, we're not gonna finish the garage. Now the price that you can sell it for, rent it for, goes down. Okay. And so there's some trade-offs there.
That makes sense.
Yeah.
But you're thinking through that ahead of time.
Correct. Yes.
So that it's not a surprise.
Yes. Yeah. Correct. Yeah. And then there is the exit side of things, right? You've got how long are you holding it on? How long are you holding on to it for? If it's a flip, we're talking in terms of months. Yeah. If it's syndication, we're talking in terms of years, that kind of stuff. And then you have what you're actually going to sell it for number. That is a huge assumption. As I pick up my paper that I dropped, it's that's ginormous when it comes to calculating your final return. Yeah. Right. Being off by 10% on your final sales price.
Yeah, that's significant.
It's massive. Yeah. That's worse than messing up on your construction cost. Yeah. Typically. And so that's a big one. And then if you're refinancing it, assumptions about like, well, what loan to value can I get on the loan? What are the interests going to be? Those are all different variables that play into this thing. And so there's a bunch of different tools that you can use to figure this out. The first one is simple scenario analysis, right? This is probably the one that I start with the most. It's like, okay, well, what if we do this business model, this plan? What if we do this or this? What if we structure the deal this way? What does that look like? and just kind of
Are you like
scenario it out.
writing that out in a spreadsheet on a
Yeah,
whiteboard?
yeah. I've got a
Like,
spreadsheet model
okay.
that I'm doing it with.
All right.
Yep. Another one, and I do this one a lot with flips, is what's called a Monte Carlo simulation.
Oh yes, you've talked about this
Yeah,
before.
it's super fancy.
I can't fully wrap my head around
Okay,
it.
so essentially, you run a lot of scenarios. I do 1,000. You could do, whatever, 80,000, 100,000. Computers make it easy to do a lot of them. And then there are certain variables that you pick that are key variables.
Okay.
So in my case, I have 3 of them. I have what is the hold time? How long am I going to hold on to the property? What do I think the rehab costs will be? And then what do I think it will sell for when it's all said and done?
Okay.
So like, for example, on the sell for, the ARV part, I look at comps and go, okay, houses that were similar in size and condition and whatever area, they sold for as little as this, and they sold for as much as this. And so I get a range in there.
Okay.
And then what the simulation does for each one, it picks a random number within that range to go, okay, what if it sold for like this one? Sometimes it's in the middle, sometimes it's near the top, sometimes it's near the bottom, and it tends to be a normal distribution, evenly distributed between those two. And then it does the same thing for the hold time and for the rehab costs.
All at the same time.
And the rehab costs are another one where I think it could be as cheap as this, I think it could be as expensive as this, and then it picks a number in between that range. And so it's picking one random here, and so all the 1,000 scenarios technically have different inputs.
Yeah.
So they're all slightly different outputs. And then it just goes through and it does all the math and says, okay, here's what your profit should be as a result of it. And then you can average them all together.
Yeah.
Or look at the range of them, really.
Right.
And try to get a sense for.
Yeah.
And then
Pick
you have
some numbers that are.
And so now you have your scenario, which is like you made a single point estimate for each of those things. Then you can compare it to the Monte Carlo simulation to go, okay, where does my guess land within there?
Okay.
Yeah,
that makes more sense.
Yeah, that's kind of the idea behind it. You can also do just sensitivity analyses. Similar idea, and I do a lot of these with the syndication piece, where you're not necessarily modeling out the entire thing thousands of times, but you're more saying, it's more like, hey, maybe I have these 5 different levels. Like, what if I could sell it at for this much, or 10% more, or 10% less, or 15% more, 15% less. And you just play. It's essentially doing scenarios, but for a very specific measure that you're playing with, and it lets you look at all of them at once and kind of see different outcomes and rates.
And then as you're putting in the different rates or switching the numbers around, you're also comparing that to what you know about the market. And
correct. Yes.
You're not just choosing a random number. You're like,
right.
I think there's a range in here. What if I could get at the top of that range? What would that look like?
Yep.
What if it was at the bottom? And
Yep. Yeah.
okay.
Exactly.
And that's like a negotiating tool as well. If you're talking about doing all of this before buying a property, theoretically, you could be like, well, I think my expenses are going to be this much. I can only sell it for about this much, and you've tweaked the numbers to know,
correct.
Like, okay, I think I can get the best return.
And I think importantly, it helps me just know how conservative I'm being in these models, and how much play do I have to where, again, like, ooh, this is a break-even point here, or because there's times where it's like, man, in order for this thing to work out, I actually need to have 95% of my units rented all the time.
Yeah,
which
is like
the numbers technically work,
sure,
but in my head you go, ooh, that's not actually a lot of
very much buffer. Yeah.
on it. Yeah, so there's things like that. There's a couple of mistakes that sometimes people make. The first one is they actually just make really, really complicated models, and they look for small nuances and difference. So one of the things that, like, I enjoy the scenario planning, I think it's important, but at the same time, for me to buy a deal, it has to be obviously good.
Yeah.
One of those where it's like, even at a high level dumbed down model, I'm like, this makes sense.
Okay.
I may not be, it's directionally, I go, this is a good deal.
Yeah.
There's maybe some nuance here that I'm missing,
Yeah.
but it's a good deal. Am I going to make 35 grand or 30 grand? I don't know, but I know I'm in that neighborhood.
Yeah.
By doing the more complicated model, I can then say, oh, it's actually 32.5, and have a better estimate, and know like, and there's a 20% chance that it's actually higher if these couple things work out, and then I can manage towards those specific risks.
So you're saying it's better to have a more complicated model or better to have a more simplified model?
I think it's I didn't word it very well. I think it's the risk is you get caught up in all the small number differences, where you might say, oh man, go back to my example, you go, man, at 32,000, like this isn't a good deal, but at 32.5 it crosses into, yes, it's a good deal. Like those situations, that's not obviously good, right? Where you're like, in order for this to work out, I have to have 51% of my scenarios turn out good.
Yeah.
Like that's too nuanced of underwriting. Again, you want it to be like, oh, this is obviously good.
Yeah, I think that makes sense. I mean, you kind of want to do both, I would think, just so that you have more accurate numbers. But if it passes the sniff test at the less complicated model, then it's like, okay, yeah, I know it's a good deal. Now I can figure out the specifics.
Yep. Yeah. You got it. And I think there are just another risk is you just are using too overly optimistic of assumptions on stuff where you're like, man, these costs really aren't going to go up this high, and we will be able to turn this thing quick. And like, I think there's just a lot of that you gotta like. That's
I know
a risk.
For myself, if I made it too complicated, I would just confuse myself and be like,
there's that.
Oh, what was I tracking again?
Yeah.
So.
So that's a lot of like the short term, just looking at the variables for that specific deal. But then there are also longer term macro driving forces that I think are also good for looking at. Now we're talking 5, 10, 20 years down the line, right? And I got a bunch of them. There's your obvious one. Care to guess? It's pretty obvious. Big macro.
Natural
starts
disasters.
With an E.
Economy.
Yeah. Economic trends, right? So you're thinking about things like inflation, interest rates, market demand, just your normal economic stuff. You want to, and those things move slowly enough. Yes, there's a lot of jittering that happens in the short term, but there are some really like not too hard to understand.
Trends,
yeah, especially like market demand type of stuff.
Sure.
Here's a fun one that's hard to do: technological advancements and their impact on the business, whether that's remote work or just the software that's involved.
Sure.
Obviously, generative AI right now is this like big unknown. That's kind of like, what will the impact be on our investments 20 years from now? I was just I was listening to this podcast earlier today, and it was talking about it's a Chegg, Chegg, I think, EGG. Their stock price has dropped 99%.
Yikes.
Because what it used to be was it would take a bunch of educational content, put it together, and then they would help students study for tests. You know, it was like a study aid type of thing.
Yeah.
And students have stopped using it. They just now use ChatGPT to help them out with their studying, to answer questions. And their company, like, they're not even sure how they're going to be able to pay their bills type of thing.
Wow.
Like, it's not good. And so there's one where it's from an investment standpoint, oops.
Yeah.
You know?
Interesting.
And part of the thought that they were also talking about with generative AI in particular is, how about this? So ad agencies typically used to charge per hour to do their creative work. Well, now, like, to come up with like 20 different ad ideas. Well, now what they do is they come up with 5, and then they use ChatGPT to say, hey, give me 4 alternatives for these to get to their 20. And so projects that used to take, I don't know what's a reasonable number of hours, 100 hours to do, they're now doing in like 20.
Wow.
And traditionally, ad agencies charge per hour. And so all of a sudden, right, they're watching their revenue per customer drop. And so there's all sorts of like, what's that business model going to look like going forward in the future? Law firms, the exact same thing, right? Where they're just going to get a lot more automation, a lot more assistance. And so there's all these companies who used to charge per hour. Now what? I think about, like, for example, property management. There's a percentage based on the rent. What's going to happen in the future with software and automation that could render that particular business model done or just not make sense, or you watch revenues dramatically fall because somehow one of the cost things is like intensely human side of it just disappears. I don't know. And so those are some of those longer term questions that you want to wrestle with.
Interesting.
Another one are social dynamics, right? Shifts in tenant preferences. Could just be as simple as urban, suburban. Again, you can go like, do I want a home office or not home office? Are we going to do a co-living thing because I want to hang out with my friends, or do I want to be all by myself? And the trend, by the way, has been more and more solo, living all by yourself. But those are the kind of trends that you want to pay attention to. Regulatory risks, right? What was this now? A month ago, we were talking about different policies, and now we know which person won, and we at least know which ways policies leaned, right? Like some of those can have an impact on us, and so so those are worth talking about. It could be like zoning, rent control, even more potentially. Yeah. Though, knock on wood, I feel like Oregon has kind of settled into what it is right now. For now, we'll see.
Probably will change.
And so what you want to do with those different areas, and this is the art of the long term, Stewart's, I think is his last name. He talks about doing essentially like game it out, narrate it out, tell the story, not just like, it's more, so it's less quantitative, right? So the micro stuff, I was like, we're throwing it into a spreadsheet and it's a model. This is a lot more of, you just kind of feel it, right?
Yeah, it's like scenario planning almost.
Yeah, almost qualitative type of thing. Like, what do you think the impact on this will be?
Well, because a lot of those are not, some of them are, but a lot of them aren't like measurable in the sense of like.
Even if they are. Like, you're not going to measure 20 years out.
Right.
That's worthless.
Yeah,
so he actually recommends
do
3 different types of scenarios. The first one is you stable market, modest growth. Essentially, status quo, things keep on the way that they are with a little bit of growth. What does that look like? Again, just you could do the numbers piece. You could do just more like, and he is like, tell a story, write paragraphs of stuff. That was his style of doing it, which, I don't mind. And the second scenario is it's a sudden economic downturn, and it could be like with high unemployment or whatever, right? Things go like not in your direction at all. And then the third one is the other direction, right? Rapid market growth of one of those areas that could benefit you or not. And maybe that's part of you choose like one of them, right? Interest rates, right? Rapid increase. Okay, what's that impact going to be for us? Or rapid decrease. What does that look like? Essentially, do the base case and then do some extremes to see what that looks like, and run through the ones that you think are important to you.
Which is similar to the micro assessment. You're creating these ranges of like, okay, what if this extreme happened or that extreme happened?
Correct.
Where do I fall? And you're right. It's different measures, but essentially you're doing that same thing, creating a range of like, all right, it's probably going to fall somewhere in the middle. But
and I think there's some things,
look at the extremes.
And one of the things that he recommends is that you don't think too narrowly, right? So, and I've kind of already brought this in, right? So like generative AI is an example of a more broad, here's this thing that's not investment related, but I can already point to a couple other areas, industries that'll impact. And so to kind of borrow from that and say, okay, what will this impact be on our investing? I think, there's some bigger ones that you could game out as well. I just think, on the regulatory side of things, right? If let's say tariffs get enacted and so therefore the cost of goods being imported into the United States go up, like that could have a profound effect on, say, construction costs potentially, or something. Yeah. Depends on what it is.
Well, I could see, even affecting, if people's expenses go up, they may not be able to afford, higher rents or the rents they're currently paying, and then you have fluctuations.
Or what's more likely is it just leads to rapid inflation, and therefore you go, okay, what are some of those things that are going to happen to offset it potentially? Again, kind of all depends on what it is and how it goes down. But that's but that's the point, right? The potential is that thing that you want to model out. And his point isn't just say like, how do I say it? You want to have that open mind about it, right? You want to say, yes, they could come in and things could go up, or they could go down, or they could stay the same. Like, game it out. And you want to look at your business model, your business plan, your investment strategy, and say, what happens? How do I hold up on this? Are there certain checkpoints where, hey, if this happens, I need to go back and reevaluate my portfolio and make a move sooner rather than later? Like, that's his point. His other one is, and I thought this was interesting, is ignoring black swans. Those are low probability, high impact events.
Like a natural disaster.
Yeah, that's a great one. What happens if there's a massive earthquake?
Yeah.
And it causes
what happens if the world explodes?
Yeah. What if World War III starts up? That kind of stuff.
Yeah.
Low probability, but
some would say higher than others, but
at this current moment in time, yes. But higher impact.
Yeah.
Very high impact on what happens. I'm trying to think.
And he says ignore those?
No, he says that that's the mistake that people make.
Oh, that's the mistake.
Yeah.
I was like, I think you should ignore those.
No. He's like,
he agrees.
And the answer might be like, I don't know, man, we're hosed. He goes, okay.
Right,
but that's where things like
think through it.
Productive paranoia come into it. That's the Bill Gates principle.
Yeah.
Saying like, like, what should we do
about
this?
It makes sense. You don't want to be shocked. And if you think through all the extreme possibilities, then when you come up against different scenarios, you won't be shocked.
Yeah.
You're like, this isn't as bad as
another
I thought.
Another like low probability, high impact would be, what if hypothetically, this isn't hypothetical, you have a property manager who stops paying distributions for a couple of months, right? That's one of those like, wow, that's a black swan type of thing. Wouldn't normally expect it. What do you do? What's your reaction?
Yeah.
And how what do you do when something like that happens? Again, I wish that was just a random hypothetical, but we might share that story someday in the future. But anyways, that's the kind of stuff that you want to think through. And so I think when you combine those two things together, right, when you are thinking first and foremost long term, okay, what are those big forces? This will influence the type of investments that I make or that I stay in, the directions that I go. And then once you've kind of categorically decided, like, okay, this makes sense for me long term, given where I think things could go, that's where you look at specific investments and you get more micro and you focus on those key variables and saying like, okay, now I want to stress test this thing, with doing some actual financial modeling type of stuff. Yeah. And so anyways, I think combined, that's how you think about different scenarios and different risks, and like that's how smart investors do it.
Nice.
Yeah. There you go. And I like to think that we are smart investors. As you can guess, we do a lot of that kind of stuff. And so if you are into that, we would love to partner with you and have you join us. And so you can check us out at fertilo.com to learn more about our investment thesis and how we think about investing just in general. And so with that, thanks for listening and have a great day.